Hey, what's up everyone and welcome to the School of Personal Finance. In today's video, we are going to talk about the importance of diversification and how to put together your own asset allocation in your retirement account. So in like your 401k, your 403b, 457 plan, IRA accounts. We're going to focus on the equity piece today, the stock portion of your allocation. I'm going to do another video where we focus on the bond portion of your allocation. With the recent volatility lately, this is the number one question that I've been getting. Should I make changes to my asset allocation? Should I get more conservative? Should I move some money out of the stock market and into different investment vehicles like money markets or bonds? So, what is diversification? From a very high level, all it really means is having your assets divvied up amongst many different types of asset classes. So, stocks, bonds, maybe gold, crypto, real estate, all those different things make up a diversified portfolio of your assets, right? And how you allocate your money to each one of these different types of investments, that is how you come up with your asset allocation. So when we're talking about retirement plans specifically, usually the options are a little bit more limited. And there is something called target date retirement funds that make all of this much easier, where it's really like set it and forget it. But I'll get into more specifics with it, but I just want to keep this high level and make it simple for people to go into their own retirement account and make changes if they want to, or at least to understand what their portfolio looks like and what their asset allocation is and how much it's costing them, what their expenses are inside of the plan. So what I'm going to do is I'm going to go ahead and share my screen with you. We'll start looking through some examples. We'll look at some performance of how some asset allocations and some funds have done over the last couple of years, and we'll go from there. I hope that you find it helpful. All right, let's get to it.
Real quick, head over to schoolofpersonalfinance.com where you can learn more about the membership club that I'm going to be launching. You can also learn more about working with me one-on-one. Jump on my email list. I send out a newsletter, resources every once in a while just to help you master your personal finances. All right, so as we jump in here, my disclosure, none of this is investment advice. I don't know anything about you. I'm not recommending any of the funds that I'm showing in the illustration here. All of this really comes down to your own risk tolerance. I might have a very high risk tolerance and I'm fine being super aggressive in my retirement accounts. If you don't have the same risk tolerance as me, then it's going to be a roller coaster ride for you, right? You don't want to put yourself in that situation where you cannot sleep at night because your portfolio is losing money. So risk tolerance really comes into play with all of this stuff. Now, my opinion, and I'm making some assumptions when I use the data in here that we're going to go through, but my opinion is if you are in your 20s, your 30s, you're up to your mid 40s, I really do believe that being 100% in the diversified stock allocation for your retirement accounts is the best way to go. Even if you're 45, I'm 47 right now, and I'm still 100% stock in my retirement funds, right? I don't plan on touching this money for another 20 years or so. Even if it's 15 years, I have a long-term time horizon, and I'm willing to roll with the ups and downs. I look at it as like an opportunity to just continue to add. Now, if you don't feel the same way, if you don't like the roller coaster ride, then you don't want to have 100% allocation to stocks. And as you get older, as you get closer to that retirement date, you definitely want to have some more stabilizing pieces of your portfolio. So some bond funds or money markets, things where it's going to smooth out the ride a little bit and you're not going to be experiencing these highs and lows as you approach retirement. But as far as the purposes for this video, we are just talking about the stock allocation. So if at the end of the day, if you decide that you only want to have, say, an 80% allocation to stocks, then you would just have to take these percentages that I'm using and apply it to that 80% of your stock allocation. And then in the future video, we'll talk about the bond allocation of your retirement accounts. All right, so what I did here is I just created a very simple example. Again, the funds that I chose in here, they mean nothing. I just picked popular funds that are easy to pull up data on, but we could put together a well-diversified portfolio using these funds. So in this example here, I'm going to actually go towards holdings. And you could see for the biggest holding in here, I am using the S&P 500 index fund. Now, in many 401k plans out there, you're going to have this option. The S&P 500, right? It's the 500 largest US companies, and it just follows the price of that. It follows the index. If you turn on CNBC right now, you could see what the S&P 500 is currently doing. So half of the allocation, half of the stock allocation, I show here as to the S&P 500. And then For developed international companies, we have an index fund here, 13%. And if we scroll down here, we could also see I have another 7% for emerging market companies. So that's an overall allocation of 20% international companies. So far we're 50% large cap US companies, the S&P 500, and we're 20% international, where 13% of that is developed countries and 7% of that is emerging markets. Now, all of these options should be available to you inside of your 401k plan. And you also want to look at the expense ratios for each of the funds. You want to have low cost index funds, and hopefully your 401k or your 403b or your 457 plan, they offer these low cost index fund type options. All right, now I have 12%. I'm using the Vanguard Growth Index Fund. This is also similar to like a NASDAQ fund, or QQQ is another symbol of a large cap growth fund. Now, those have done great over the last few years. And I'll show you a longer term chart of companies of large cap growth. 2025, they're off to a very shaky start, but for the last couple of years, they have just been ripping higher. They have been the best performing asset class out of all of these different sectors. All right, then beyond that, we have an allocation to small cap. Now, this is a small cap blend. So it has small cap growth, small cap value, all in one index fund. So that is 10%. Then we have a mid cap blend fund, which is 5%. And then I use gold for 3% in the portfolio. So as you can see, inside of this stock allocation, we've hit all the different segments of the market, right? We have large cap blend, large cap value, large cap growth in there. We have international, we have developed markets, we have emerging markets, we have small cap blend, we have mid cap blend, and then we also have a gold piece, right? A commodity piece added to the portfolio. So in my mind, right, this is a very well diversified portfolio. Now, does that mean that this is going to do better than if you choose to go down the road of maybe just having one fund? Many people just choose to go with one fund for their stock allocation in their retirement accounts, like an S&P 500 fund, right? Or a total stock market index fund. Which one would actually perform better? And of course, my answer is nobody knows the answer to that question, right? But over the last 10 years or so, the S&P 500 has pretty much outperformed all types of diversified portfolios because large cap companies in the United States have done great. They have outperformed everything else. International companies, they've been left by the wayside over the last decade. So even though they're off to a great start in 2025, they have underperformed the USA big time over the last decade. Small cap, mid cap, all of them have underperformed. So that brings up the question, should you just stick with the S&P 500 or a total stock market index fund? And the answer is it really comes down to you and what you're comfortable with. But if you go back, if you look at the S&P 500 since, the 1930s, it has averaged a little over 10% per year. So anybody would really be happy with that. But what diversification does is it just smooths out the ride a little bit, right? It allows you in years like this so far, in 2025, where international has done very well, gold has done very well, where it kind of softens the blow when the S&P 500 is not doing as well. So it's a hard question to answer, but at the end of the day, if you like to just keep things very simple and you just want to have one fund inside of your retirement account, choosing a total stock market index fund or an S&P 500 index fund, at the end of the day, you're going to be absolutely fine. You will have the roller coaster ride of the stock market, right? You're investing in stocks and there's a risk to that. So like 2022, we were down over 20%, right? 2009 was a disaster, right? At the lows, we were down close to 50% and the market was down close to 40% for the year. It was a very rough year. So you have to expect that those years are going to be mixed in. But when you zoom out and you look over a long period of time, if you just invested in the S&P 500, getting a 10% annual return over a long period of time, that is a great way to grow your wealth for your retirement. All right, now let's do some comparisons. If we take that diversified portfolio that I just showed you and we go back and we start, the max date we could start at is September 8th of 2010. So from that period until today, a $10,000 initial investment would have grown to $52,250. So if we look at it as percentages, that is up 422% since the initial investment. Not too bad. All right, so now let's go ahead and we will add the Vanguard S&P 500 Index Fund to compare it. So over that same time period, you could see that the S&P 500 is up 569%. So that is a big difference. If we look at dollar amounts, your $10,000 investment, it would have grown to $66,900. So about a $17,000 difference. That's a pretty big difference right there. All right, now let's compare that to QQQ, which is an ETF, a spider ETF that tracks the NASDAQ 100. So if we look at that one, that has outperformed everything by a mile, right? Since 2010, September of 2010, $10,000 invested in that, that would have grown to $117,000. That is such a big change. If we look at percentages, right, that's up over 1,000% since the initial investment. All right, now let's add the iShares MSCI International Developed ETF. As we could see, that has done nowhere nearly as good as the US markets, right? So since September 2010, it is up 143%. So if we look at dollar amounts, 10,000 invested in there would be worth $24,390 compared to if you invested it all in the S&P 500, that would be worth $66,000. Compared to if you invested it all in the NASDAQ and the QQQs, that'd be worth $117,000. Now, again, nobody knows what's going to happen in the future, right? So it's not like you could bet on one of these. You can't just say, because the NASDAQ was up so much over this time period, that I'm just going to invest all my money in the NASDAQ going forward. There's a lot of risk to doing that. If we go back to the dot-com bubble, the triple Qs at its low was off 80% from its highs. So if you had $1 million in there, your $1 million would have been worth close to $200,000 during the dot-com bubble. Imagine going through that kind of pain. It's very hard to sit through that and wait for a rebound. So that's why you want to have a diversified portfolio, so you don't get clobbered in those years when we have a bursting of like a dot-com bubble. All right, now one more comparison I just want to show you, and then we will move on, is what's called a target date fund. So now many retirement accounts now offer target date funds, and they are set it and forget it. So you could just choose that one fund. You choose the date that coincides to when you want to retire. So in this example, I'm using a 2060 fund, right? Because that's going to be aggressive. If we're going out 30 years, 35 years, then that is going to be an aggressive allocation. All right. Now it's important to understand what is under the hood of the target date funds, because they're different depending on the fund family. Like for Vanguard, for example, for this 2060 target date fund, there's 10% that is allocated to bonds. All right. So it's 90% stock, 10% bonds. And then out of that 90% stock, there's the total stock market index fund, all right, where you get exposure to the entire US stock market. And then they have the total international stock market index fund as well. And then for that 10% bond piece, they have the Vanguard total bond market index fund. So you get exposure to the entire bond market. And then you also have the total international bond market index fund. So you get exposure to the entire international bond market. So it is very well diversified, even though there's only 4 funds underneath the hood of that one target date retirement fund. So when you choose just that one target date fund, you're getting exposure basically to the whole world of stocks and bonds through that one fund. Now, because it has a bond piece, it is not done as well as being 100% stocks, because stocks have had a great run in this chart that we're doing a comparison on, right? So now this is from 2012. That's the earliest data on the 2060, the Vanguard Target Retirement Date Fund. And you could see over that time period from January of 2012 to today, you would have done significantly better investing just in the S&P 500 or the total stock market index fund. Again, that makes sense because stocks have done very well in the United States compared to stocks internationally, and also when compared to bonds. All right, stocks have really done what we all hoped that they would do since 2010, right? We had the Great Recession, 2008, 2009. Since then, stocks have really performed very well. Now, the nice thing about these target date funds is they will automatically change the allocation as you approach the target date. So as you get closer to retirement, they will automatically get more conservative. They will move more money from the stock portion over into the bond portion, so you don't have to worry about doing it. And now one more chart that I want to show you, and then we'll wrap this up. This is what we call a plaid chart in the financial world. And as you can see, the S&P 500, right? These are the ones in red. Then we have a balanced portfolio in blue. So what this is showing is the annual total returns for each of these different asset classes. So the S&P 500, commodities, small cap, a balanced portfolio, international, developed countries, fixed income, and emerging markets. So they put a line through the chart here of this balanced portfolio because you could see that it's usually in the middle. If we look at 2025, for example, right, the S&P 500 is down towards the bottom, down 3.9%, and we have the international developed countries up almost 10%, commodities up over 7%, right? If we look just the year before, 2024, you could see the commodities were at the lower end of the chart and so were the international companies. The S&P 500 has been doing very well. As you can see, since 2010, almost every year it is in the top two of asset classes. We have a couple years where it's a third one, but for the most part, it has really outperformed everything else. And again, I just want you to realize that that might not be the case going forward. We can't say for certain that it's going to continue. The US is going to continue to outperform. That's why I really do believe you need to have at least some portion of your allocation towards emerging markets, towards developed countries, to have some in commodities, even if the larger portion of your allocation, which I do believe it should be, is geared towards US companies. And even with the S&P 500, I do like to pair that with a growth fund, especially if you're young. If you're younger than 50, I think that you should have a growth portion geared in your portfolio. Now, again, this is just all my opinion. Everybody has their own opinion about this stuff. You can slice and dice this stuff a million different ways, right? There's no correct answer for everybody. So you really have to dig down deep to how you feel about it, to your risk tolerance before making these decisions. But overall, it's pretty obvious. The US stock market, that has really been the place to be for the last 25, 30 years. Will it continue? Nobody knows. But it is the largest portion of my retirement accounts. And, if you have a long-term time horizon and you could stomach the volatility, I think that it will continue to be a great place to invest your money for retirement in the future.
All right, that is it for today. I hope that you found that one helpful. Please make sure to check out schoolofpersonalfinance.com. I'm going to be rolling out that membership program that I talked about in my last video, where I'm thinking it's going to be like $25 a month. I'm going to have a ton of resources on there. We're going to do live classes. I'm going to have pre-recorded classes where I teach you how to achieve a certain goal step by step, where you can walk yourself through the course at your own pace. I'm going to have also office hours where you can just drop in and ask me any questions that you have. Now, again, this is not me and you working one-on-one as your financial advisor. This is all for educational purposes only. So go check it out. Make sure to subscribe if you're not subscribed already. Hit that like button if you enjoyed this video. I'll see you again in the next one.